is. Hi, Nana.
All right, we're back. We're in business.
Yeah, but I don't know why you're.
Hello.
good. Go ahead.
Hi, Nana. We're waiting for everybody else.
For some reason, the camera's not working, so you can't see us.
We're having all kinds of technical difficulties. Are we still on mute or no? She
Mm-mm.
can hear me. She's on mute.
She's on mute.
Yes, I can hear you. Sorry.
Yeah, we are having all sorts of technical difficulties, my friend. So
Sorry.
what's going on, including our speaker who doesn't seem to be here. So I'm gonna let Heather keep an eye out for her, and I'm gonna go see if I can find her cell phone number because little concerned.
Okay. I'm here. Don't worry.
Saying that they're having some sort of issue.
Somebody else got on. Dwight.
Hi, Dwight. How are you?
Doing well. I don't know if you all can hear me. I'm driving.
Good. Thank you for joining us. We are. Is anyone on yet? Yeah, yes. Hold on, trying to get my speaker connected. We'll be right back. Let me call her. She says, I'm on the call. This is different from Zoom. So I don't know. You should just follow the link I sent to everybody else, correct?
Right. And then I can make her a host.
Yeah.
I can talk.
Hi, everybody. There's just a few of us here right now. But Sue has joined us, our speaker this for the evening. This is Sue Yoakum. She's with Dover Federal Credit Union. Very grateful to her for presenting this to us. I think debt management is something that no matter where you are in your financial journey, we all could use some help with. And, you know, hopefully with the goal of eventual home ownership, she can give us some pointers, and also some of us are already on the path of home ownership or have owned a home. So I am looking forward to her talk this evening. She is currently sending me, while we wait for a few more people to get on, who said they would be here. She's gonna send me some attachments. You don't need them for this session, but they will be helpful to you afterwards. So I'm gonna go ahead and email them all to you. Thank you guys for responding to all my emails. We are having a great many technical difficulties here, and including the camera on the laptop we went to use, it doesn't seem to be working. So you won't be able to see us, but Heather and I are sitting here learning alongside of you. Thank you. We'll let Sue talk whenever she's ready. Okay, go ahead. Sue, if you're speaking, we need you to unmute yourself.
Oh, wait, I'm not speaking yet.
You're
I want to
loaded.
get,
Okay,
I want to
we got
get back
it.
to the first page. I just sent you the attachments, so if you want to confirm that you did get them.
I did. I
Okay,
did. I see 6 handouts. Is that correct?
yes.
Okay.
And I have them in front of me, but they're really just some tools for them to use later on. The first one is a listing of where you would write down all the debts you have, and be specific, like a MasterCard, a Visa, what store card, mortgage, car loan, and then the current balance and the monthly payment. And that just kind of helps you get an idea where you're at, because unless you, that's the hard part, trying to really see where you're at. Nobody wants to write it down because it's depressing. The second
It is.
handout, we're just going to go over them together. I'll ask a few questions from each of the worksheets. What's a pro and a con, what like a good debt or a bad, and the second, third, and fourth. Then there's an exercise for people who aren't in a position right now to refi because maybe they're working on credit or a little overextended. We have a page 5 actually, and I'll talk more about it in the presentation. And the last worksheet is a budget, which we will just basically touch on because there is a whole class for budgeting. So when you're ready for me to start, I will. I don't know why you can't see me because I have my camera on, and I'm going to shrink this just a minute, make sure I get out of the other meeting. I was in
Nobody can
another,
see us
I was in a
either.
Google meeting, and
Okay.
I'm not sure if that's conflicting with the camera. You know what I mean?
Yeah, no one can see us yet either, so.
And actually, that's fine if you can't see me. I mean,
Well, we want
Hi.
to make sure everybody's here and awake and paying attention.
think
I love to see
I prefer not to be seen.
you.
Let's see. All right, let's see. I want to bring my screen back up.
All right.
Hmm.
Anybody else pop into our little window yet?
Nope.
No?
Just Meta and Dwight.
All right, well. What time is it?
Okay.
Sue, whenever you're ready, this may be it.
All righty, let me go back to share screen then. I had taken it down. Okay, so I'm going to share screen. Here it is. We're back on the right page. Okay, can you see my screen?
Yes.
Okay.
Nana and Dwight, can you see Sue's screen?
Yes.
Excellent.
It's funny that we can't see any of the participants.
Yeah, I don't know what's going on.
Let me go look and see if I'm going to drop down and see next to it, like if it says anything like. No, the cameras aren't like my camera's uncovered and whoever CDHFH is, that camera's uncovered.
That's us.
Huh.
That's us.
Alrighty, well, thank you for those of you who are on, and if people jump on, that's great. We can, if you have a question, feel free to unmute and ask. I don't mind interruptions because I feel like then I know people are there. And I apologize, you can't see me. My screen is not, it's uncovered and I opened my little, screen blocker, so I don't know what's going on, but how to manage debt so it doesn't manage you. I'll tell you that, to me, that is so important because debt is the cause of a lot of people's illness and stress, and it just the biggest cause for most people fighting. So we're going to talk about different types of debt, what's good and bad, how much it costs to borrow money, some warning signs you may be in too much debt, and then how to manage the debt that you already have and what to avoid. So they're the things that we're going to be talking about tonight. I'm going to go through it rather quickly because without being in person, sometimes it gets boring if it's lengthy, and then I don't mind interruptions at all. Please interrupt me if you have a question. So this is just a basic definition of debt. It's money that you borrow from another party. Typically people borrow money for larger items that they otherwise wouldn't get, but you make an arrangement where you're going to pay sometimes fees to borrow the money and then interest, and you pay it back at a later date. So most of us would not enjoy home ownership or a vehicle ever if we had to save up for it. So there are good reasons to get into debt, and then we'll talk through some of them. It's really significant when you come to a financial institution or a lender, you want to understand the terminology. I take for granted that everyone knows it because I'm in the industry, but if you don't work in a financial industry, sometimes when people are talking fast, you don't understand what you're signing. So does anybody know what secured debt is versus unsecured debt? I'm going to tell you if you don't. So secured means the financial institution will not take a total loss if you don't pay for your loan, because you're going to be putting up a home, a vehicle, or you have cash in the account that we can freeze and you can't touch it when it's frozen. So suppose we did a home loan for you and you stopped making your payments. We are not in the business to sell homes. We do not want your home, but the only recourse we would have to recoup some of our money back and not take a total loss would be to take the house back and sell it and gain some of the money back that you owed us. That's a last resort. We don't like to do that. We don't want to foreclose on anybody. We don't want to take your house and have they have a bank auction and somebody comes and buys it for probably what's left on the mortgage, but that doesn't include fees and everything. Unsecured means you're not putting up anything. It's all the frivolous things that maybe we put on the credit card. Maybe you had to put groceries on the credit card, or clothes that you've since gotten rid of, or just activities that you've done, or just random things. We can't take that stuff. So that's a total loss if you don't pay that type of debt. Unsecured means we have nothing tangible to come after. Fixed interest versus variable interest rate. Does anybody know the difference between the two? I'm going to tell you. A fixed interest rate, it means whatever rate we approve you at is the rate for the life of the loan. If it's an installment loan, you're going to have equal payments over the life of the loan until you pay the loan off, and then it's finished. Fixed means the rate doesn't change. So if you got a mortgage at 3.5%, it's always going to be 3.5%. Now, let's suppose you got a mortgage at a variable rate, which I most of the time would discourage. A variable rate means if you got a mortgage for 3.5% and then the economy starts to have problems, your rate can go up. So the payment you may be able to afford today, you may not be able to afford if the interest rate goes up, because if you're paying 3.5% and the rate would go up to 6, 7, 8, 9 or higher, the payment would jump significantly, especially on a loan with a large amount. If it's a small loan, it might not impact you greatly, but a home is a large loan. So whenever you go into a lending situation, you should look for a fixed rate. So make sure you understand when you're signing that the rate's not going to change. And then the last one, I kind of gave it away a little bit, an installment credit versus revolving. Some
Sue,
yes.
so Dwight actually knew the answer to the last one. Do you want him to try and take this one?
Oh, please, yeah, absolutely.
Revolving?
Yes.
Dwight, do you know this one?
I'm gonna take a guess. I'm gonna
Okay.
just go based on the words. I'm assuming installment means you pay maybe the same amount or just a payment plan option. I don't know what revolving. The only thing I can think of is it's like you pay it down, then you get a little. I'm thinking like a credit card. You pay it down, and then that amount opens back up from what you borrow. That's what I'm saying. I don't know.
That's exactly correct. So if it's installment, it's like the payments like on a car loan or a home loan, they're equal payments. You pay them the same until the loan's paid off and then it closes. You can't borrow against it. It doesn't become available. Revolving is right. It is like the credit card. As you're making payments into it, you can reborrow it without having to apply again for the loan. That was excellent. So very good. And the reason I stress this, a lot of times we're excited about what we're buying. We'll sign anything because we're so happy about what we're getting. But then when it's time to pay for it, if you don't understand what you got yourself into, it can be a nightmare. So here's some examples of what we just talked about. Secured loans are like car loan, mortgages, because there's something the bank could take if you didn't make your payment and they could sell and not take a total loss. Unsecured are your credit cards, personal loans. We don't have anything, and it's a higher risk. And chances are the rates are going to be higher too because of the risk. So they try to make money up front to make up for potential losses later. And then installment versus revolving. Installment again is like a mortgage, car payment, even a student loan. Equal payments the same time due every month until you pay it off and then it closes out. The other ones, a credit card or cash advance, these are loans that as you pay them down, they become available to use again. Sometimes though, if it's like a home equity line of credit, you may be able to draw money on it for up to 10 years, but then the draw period stops. So make sure you understand that as well. Whereas the credit card, as long as you're making your payments, they typically don't close your card. Sometimes if there's inactivity on a card, the person who gave you the card, like the department store, the gas station, the bank, if there's no activity for a long period of time, they may close the card out, assuming you're not going to use it, because having a card sitting around without any usage, there's a chance that somebody might start using that for, identity theft, get that number, realize you're not using the card and maybe start doing some damage. So if you're not using the card, you may not want to have it. And then one of the things too, you have to use credit to have a good credit score. So we'll talk a little bit about that later. So then the last one, the fixed interest rate versus the variable. Again, on your installment loans, typically your secured loans, they're going to give you a fixed rate because it's usually not as high risk. The variable interest rate is going to be on the higher risk lending, such as those open lines of credit. So we're going to move along. That screen I felt was important because you don't want to sign something you don't understand. Basically, there's just 4 types of loans that we typically deal with. So you have mortgages, and I believe you all know what they are. That's what you get for a home. Then there's vehicle loans. Again, that's pretty self-explanatory. There are different types of credit cards, so you have to be careful. There's a charge card that you have to pay off the entire balance at the end of the month. And then there's a credit card. It's an open line of credit, and you only have to pay a minimum. Make sure when you apply for that credit card, you know if it's one that has to be paid in full every month or one that you can make payments over time as long as you make the minimum. So that's a little difference. And then the student loans. Again, they're more like your mortgages and your vehicle loans. While there isn't a collateral, typically when someone goes to school, they've gotten an education, so they're going to be able to get a better job and be able to make those installment payments, and they spread them out for, I think, up to 10 years. But A credit card is also comparable to a line of credit. That's why we didn't put up a separate category for that. Moving right along. So these are some of the worksheets you're going to get, and you can skim through. I'm just going to throw out a few examples, and you can tell me if you think this is a pro or a con of credit. By simply having a credit card available, a person is likely to spend 34% more than he or she might otherwise spend. Is that a pro or a con of having credit? I want to come off mute. If having a credit card is going to, okay, go ahead.
Nana, go ahead, Nana.
Oh, sorry, I said cons, sorry.
It is a con. That's absolutely correct. If a credit card is going to have you spending more and being more careless in your spending because it's plastic and you're not thinking about the money, that's a con. So when people used to come in, apply with a credit for a credit card with me, and they told me they have trouble controlling themselves, we talked about maybe some other options for them because I don't want to help them get into trouble. So 2, credit can allow you to take advantage of sales when you lack cash to make purchases. Is that a pro or a con?
Dwight, you want to take this one?
Pro.
It depends how you look at it. If you, for example, if you school shopping comes up and you get paid the week after the sales, and if you had budgeted some money for school clothes, but you just didn't have it this week of the sale, yeah, get the clothes on sale. Of course, that's smart. And if you pay the bill off in its entirety, when it comes in, you don't pay any interest. So it is free money for not quite a month. And but if it's going to prompt you to buy more than you would have if you had the money in hand, it could be. So there's really no right or wrong answer with credit. We always tell people that credit is amoral. What do you think that means? Amoral. Immoral means bad, right? And then moral means good. So if credit's amoral, it means it's neither good or bad. It's really just the discipline used. So here's another one. Having a credit card can provide cash for emergencies, such as paying to repair a car. Do you think that's a pro or a con?
Nana, we'll take turns. Nana, you want to try this one?
Again, sorry.
Having a credit card can provide cash for emergencies, such as paying to repair a car. So is that a pro or a con?
Con.
And why do you think that it's a con?
So now that's where I become speechless now.
It's okay. So I told you it's neither right nor wrong, but here's the thing. If you need your car to get to and from work and your car is not going to run without the repairs, it may be the only option you have because it's your means to get to your job. But it's a con if you had some time to prepare for the car repairs and you just were careless with your money. So one of the things we teach in our Take the Wheel class is about when you're buying a car, don't get the maximum car that you can afford. Like don't say I have an extra $500 a month. I'm going to spend $500 on a monthly payment because you forget there's gas, there's insurance, there's transfers and tags initially. Then there's also maintenance, and people always forget the oil changes and the different things. So it can be a con if you're constantly relying on credit for the car, but if you need it for work, it could be a pro. So neither right nor wrong. Just thinking through your purchases. Credit can be used for an investment such as a house. Is that a pro or a con?
Dwight, your turn.
That's a pro.
Yeah, because you know what, we have to live somewhere. And if you're renting, you're kind of throwing your money away. But at the same time, it can be a con. Some people buy more house than they really need, trying to outdo people. If you buy more house than you really need or can afford, that's all you're going to be able to do is go to work and pay for your home. It takes a lot of the enjoyment out of life. So again, it's all relevant to how you want to live your life. Here's one thing to look at though. When you do put things on credit, it wasn't meant to be an extension of income. Credit was for the things that we need to live. Only three things we need to live: Can you tell me what they are?
All right, Nana, go for it.
Um,
What do you need every day?
Yo, number one, moto. I need car.
What do
I
you
need
need?
Car.
Car? Well,
Sorry.
yes and no. I mean, the three things that we need just to sustain life, we do need food. We need shelter.
Okay. Sorry, I didn't know that's what you meant like that. I
Yeah,
thought
yeah,
you meant- Okay.
and
Water.
clothes.
Water. We need food.
Yes, and that
Ah.
goes under food. So food, shelter, clothing. So here's what, when you're really trying to stay on budget and try not to overspend and rely on credit, ask yourself when you're going to make a purchase, do I need this today? Or can I wait? Can I set a goal and save up for it? Do I need it to live? If you don't need it to live and you didn't allot some extra money in your budget for it, I'd say wait, because when you put things on credit for frivolous needs, I mean, frivolous wants, when a need comes up, such as getting the car repaired or getting, you're low on money and you need to get groceries or a home repair, that's when your credit starts to snowball out of control. We're just going to do a couple more of these just so kind of want you starting to think about credit's not an extension of income. It's for the things we need. And you do need a car, right? Most likely to get to and from your job, but there are other ways if you had to, buses, carpooling and things like that. But I know that would be difficult. One of the things about debt, it can take months or even years to pay off. So that's how you just don't want to get into that excessive debt. Excessive credit use and late payments will damage your credit history, which may prevent you from getting insurance or even a job. So when we get into that vicious circle of getting too much debt and just trying to make the minimums and all, it dips our credit score, because one of the factors in your credit score is your is the amount of debt that you have based on how much you make, your debt to income ratio. And then also if you have lines of credit, like a credit card, $1,000 credit card or $20,000 line of credit or whatever, and all of those balances are used to the max, you look like a high risk person. So it dips your credit score. The bigger part of your credit score is paying on time. So if you dip your credit score, you're not going to get the best interest rates when you do get a loan. So you're going to be paying more interest for the same money that someone else might get for a lower interest rate. So, and then as for me, I am in a financial job. I might not have gotten hired if I had a low credit score. So overspending also affects your credit score and impacts your getting a job. And this isn't really fair, but when you go to get car insurance, if you don't have a good credit score, they charge you more because they look at you as a higher risk, which again is not fair because your driving has nothing to do with your spending. But that's one of the things that happens. Some good uses of a credit card. If you carry cash and you lose it, are you getting it back?
No, we are not
Yeah.
getting it back.
No.
I'm gonna take
If you have a credit card or a debit card and you put the money aside in your paycheck to pay the bill when it comes in, suppose, you had a dispute, you order something online or, even at the grocery store. The merchant at the store owner, the grocery store, or whoever you ordered from the catalog online or, on the websites or whatever. If you have a problem with your order, they're not likely going to hurry up and help you out. But if you go to your financial institution and dispute it, your items were damaged, you never got your items, or you didn't get all of your items, you're going to get your money back. So there are good reasons to use credit. When you travel, you cannot rent a car without a credit card. You can't book a room without a credit card, because one of the things is they want to make sure that, like, suppose you don't show up, they reserve that room. You have 24 hours usually to cancel. If you pay upfront cash, if you're in person and can do it, maybe once in a great while that'll work, but really to reserve a room ahead of time and make a plan, you can't. The last couple of years, we all got used to having to do a lot of things from home. it would have really been hard for people if they didn't have the ability to order things and pay over the phone to get them delivered. So just use credit responsibly. And I'm going to skip ahead now. I just wanted to give you some of those examples. When you get your worksheets, you'll be able to look at some of the others. So we're going to skip this one. It's more of the same. I'm going to skip that. So what is good debt? And when we ask questions, a lot of time the answers are up here, but good debt helps to increase your net worth or help you save time and money. So education debt is usually good. It's going to get you a better job, but there's always a con. If somebody's a professional student and they keep going to school and never get a job, they're just running up debt. So, you have to use your head here. Bad debt is everything else. If it's not going to save you time or money, invest in yourself or your future, or, then it's not good. A home is a good debt because typically a home appreciates in value. While we don't want car debt, a car does get us to our jobs, and it's convenient because if you had to follow someone else's schedule all the time, that's really hard. I want to look in the chat, make sure I didn't miss anything. Oh, okay. Let me move ahead. So bad debt's all those things that we put on there that we think we want, we forget about right after we get them. So here's your examples of good debt versus bad debt. And basically, I just told you that. So try to think of,
Heather has a
I have
question.
a question.
yes, please.
Would a house be considered good debt then?
Yes.
That for the most of the time, a house is a good debt. Let me give you an example when it's not a good debt. Some people's eyes are bigger than their wallet. They're, if you buy a house that is going to consume every cent that you make, and you're going to be house poor and you can't do anything else, you can't even afford your utilities and groceries, that is a bad debt. If you buy a house that makes sense, and you usually can't even get a mortgage because they have, unless you have a certain debt to income ratio, they look at everything that you owe, and they won't lend you more than they think that you can manage on your own pay. But they can't see your insurance. They don't know how much you eat. They don't know that your other activities, salon, just miscellaneous things in your life, gym membership, that doesn't show up on the credit report. So if you buy a reasonable house, if you buy a house, it's going to be a little struggle initially. And as you get more advanced in your job, it gets easier. But a house is typically one of the good debts because we do need somewhere to live. And if you weren't living in a house, you'd be paying somebody else's mortgage. Because if you rent a house or an apartment, the owner of that building is you're paying their mortgage or their rent, so it is typically a good debt, but there are some, so that's a great question. So cost of debt, here's the things you should consider. First, can I afford the purchase? It's really hard just in a random moment to know if you can afford it. If you don't have a written budget, I suggest that's the first thing you do. We have page 6 actually has a budget for you, where on the left side, you write down everything you earn in a month. And then on the right side, you list every expense you have. And when you get your budget sheet, you can just customize it, make a copy, line through the categories, personalize them, make them your own, think through it. The ideal is to do it for a year. So you could put everything on the left that you make in a year. And on the right, the total of all your utilities for electric, the total of all your phone bills. When you divide the number by 12, then you'll get your monthly budget. And since most people get paid every 2 weeks, so you end up having a couple extra paychecks, but some of your bills come in instead of monthly, they might come in twice a year, or they might come in once a year. You might get hit with an income tax bill. By having a written budget, it takes the guesswork out of it. Not saying it's perfect, because emergencies and things that you can't predict are going to come up, but that'll help you. And then what you do for those things that you want that you simply don't have the money for right now, you set a goal for when you want it, 6 months, a year, whatever. You look at how much extra money you have after you pay all your bills every month, and you save a little bit each pay period. So you might say, I want to take a trip next year. It's going to cost me $1,200. I got to save $100 a month. That's $50 a paycheck, or or whatever that looks like for you. Just, and break it down to little goals. Don't be throwing it on credit, because then when you have a real emergency, that's how it goes out of control. So then think about this. I put this stuff on the credit card, because I had these emergencies. But then I had a few opportunities to get a couple frivolous things and I bought them. Well, now my credit card payment monthly, the minimum, is every extra cent I have. So that little cloud on the right is what is the opportunity cost of taking on the debt? So that means if every extra cent I have is going towards my credit card payment, and I have an opportunity to do something fun with my friends, I can't do it now. So you're spending your future income. And I already said, ask yourself the question, do I need this or do I want it? If you have the money in your hand to pay for it, and it's just something frivolous, go for it. But if you are having to put it on credit, think twice. And if you're unable to save for your future, because it's our responsibility to save for our own retirement, then that's a reason too that you need to cut back. How much do you think we should have in an emergency savings account? The bare minimum. What is the minimum we should have in our savings?
Anybody got any answers?
$1,000?
And
I
then
would
it's-
say 5,000.
1,000 is the bare minimum, because most emergencies
No,
that happen
sorry, I
are,
say 5,000.
yeah, 5,000 is high, but you're right in a sense. I'm going to get back to that. 1,000 is the minimum you should have, because most emergencies we have, or inconveniences like a broken vacuum or an appliance, a dishwasher or a fridge, or we have a little fender bender, and then we have out of pocket, what we have to pay is usually a deductible, maybe 500, maybe 1,000, or maybe you're sick from work and you're on disability for a little bit. You're only getting 2/3 of your income. But the ideal to have an emergency fund is 3 to 6 months of all your bills, which takes a while to get there. Most people I know never get there until they're usually retired, because life keeps happening. But if you have a minimum of 1,000, it'll stop you from constantly pulling out the credit card, because when you start pulling it out, it gets easier to use, and that's how it snowballs out of control. So every pay period, you should have a predetermined amount of money that goes right into the savings. If you need it, it's right there, it's available, you can take it. You should also have money come out pre-tax if you have that option with your job, and start putting a little bit away for your retirement that gets matched by your company. And with compounded interest, and the younger you are, the more that nest egg you'll have saved over time, because Social Security is not going to be enough to live on. And you want to make sure you start saving for your future. So just a little bit about that. So if you're unable to save anything, chances are you're overextended. That's a sign you're in too much debt. Now, this example really brings it home for you. Suppose over time you have this credit card with an 18% interest rate. That's just unheard of. That's just a very high interest rate. And over time, some of it was fun. You had some vacation. Some of it was furniture you needed for the house. Some of it was you didn't have your medical expenses covered for the doctors and meds and whatever. Some of it was just frivolous clothes, but you spent $20,000. When you do your budget, you can only afford to make the minimum payment, which is about 2% of the balance. If that's all you can make, the minimum payment every month, it's going to take you 30 years to pay that $20,000 of frivolous things that you probably already used and gotten rid of. The interest over that 30-year period of paying off the 20 is $50,225. So the things you bought for $20,000 plus the interest of $50,225, you spent $70,000 on things that you probably already ate or threw away. When you look at it like this, how much it's costing you. So when you see those double-digit interest rates, that'll make you think twice about what you're putting on the credit card. There are other ways as you pay into your home and you build what's called equity, more ownership of your home. You owe less to the bank and you own more of the home. Sometimes you can take a loan with a lower interest rate, a single-digit interest rate, 3, 4, 5% to borrow some money if you're investing in your home or you just need it. Here's another example. So remember I said there's a couple factors that affect your interest rate. If you have too much debt or if you don't pay your bills on time. So let's just say that Maria always pays everything on time and she doesn't put much on credit. So she keeps her bills low. And she gets a credit card with $1,000 limit. And they only give her a 10% rate because Maria has a good credit score. And let's just say I have been very careless. I've maxed my cards, means whatever my limit is, I've spent it. All my cards have the max. So if I have 5 $1,000 cards, they all have $1,000 balance. Maria pays her card off every month or keeps a very low balance, maybe $100 on her card. So they give me a 25% interest rate. If Maria and I both budgeted $40 a month, that's all we can afford to pay out of our paycheck. It's going to take Maria 29 months to pay it off, but she's only going to pay $126 in interest. It's going to take me another 7 months. I'm going to take 36 months to pay off the same $1,000, and I'm going to spend $427 in interest. So the more debt you have, the lower your credit score is going to be too. So that's another reason. And when you borrow money, it's going to cost you more than other people. So if you don't understand that, please speak up, because to me, these are the examples that really hit home for me. That whatever I had to have that I spent that $1,000 on cost me an extra $427. Was it really worth it? Or could I have waited? Here's warning. Yeah, go ahead.
So
Yes.
here's my deal. And this is speaking from my own personal experience. So I sent a kid to college
Yes.
and borrowed money for parent loan.
Yes.
So the problem with that, with my credit score, is it basically looks like I took out a loan for $7,000 every year and spent it immediately and in full, which I did because it was a plus loan, but it still dings my credit because it says that I've used too much of that credit.
While I feel the same, it's not fair.
It's unfair. Is there any way to get around, to get out of that?
The only way to get out of it is if like a lot of people end up using their credit in their home when they start building equity, and they end up using that to pay off the loan because it's usually a lower interest rate. And but you just have to chunk away at that unless you can refinance it. And it's not fair, but they weigh that against people now. So the young people coming out of school, unless they got scholarships or got had someone that could pay for their college, they're crippled by this debt because they can't even, that's why a lot of people are getting homes now into the 30s or older, because it's taken them 10 years to pay off their school debt, or sometimes longer.
Yeah.
And yeah, I mean, one of the good things is if you come into any of our branches, our staff are trained on the credit score. So if they come, they'll pull your credit report.
Yeah.
They'll put together a plan for you to build or repair your credit, and they'll look at everything that you have, and they'll advise you based on what they see, your approach to what you should pay first and how to make the most of your credit score. It's unfortunate. I don't have a good answer for that because school is way overpriced, and some people get it free and some don't. So it's just, I feel bad. You know what I mean? I don't have a good answer.
Well, and it's so, I mean, I know it counts as good debt because
it's good debt,
educated and all that. It doesn't, but my credits, and I have a good credit score, but there's like a certain ceiling I can't break because I have those student loan debts that they're just not going to go away. And
it's a curse. I mean, we had the same thing. My daughter, she graduated, then she went back for a master's. She has a lot of debt for the master's. We let her pay that herself. Then she had her wedding, and now she's having her first baby. And I just said, my parents keep telling me, don't give her another thing, but we're trying to set her up to be independent. I mean, she's married, but just, you can't really advance today without education. And so we felt, we sacrificed for her, but I don't know a good answer for that one. I do know that if you talk to someone, maybe they can look at you holistically and give you a better approach of which debts to pay attention to and stuff. But
well, thank you for that, because
I feel bad because it's one of those that's just crippling everybody. And I don't know. what to
Well,
tell
I
you.
feel it for our homeowners and our potential partners too. Nana has kids, I know that, but hers are little, so they're not.
Yes,
Yeah, so they're not going to school anytime soon. And then Dwight, I don't know if he's got kids, but like I feel it for our potential homeowners or home buyers who've
here's
already
the
gone
thing
to school.
for our young people, in hindsight, if you start an education plan now, I don't know where me and my husband would have found the money because I wasn't working a professional job. Childcare was too expensive. So we chose for me to stay home for a little bit. He worked 2 jobs and then I went back to work at night. And then we worked alternate shifts so that we could avoid the childcare. But if there's anything you can squeeze out of your pay and put it into an education fund for your children, we have a financial advisor who can talk to you about that. People who do that are so much more ahead of the game than us. You know, so that's one strategy. Another strategy is some people work really hard and they're able to retire younger. So when their kids go to college, they get free school because they're showing lower income because they're not working anymore. So we didn't, my husband and I didn't use either strategy, but his brother just retired at 47. So his son will get a free ride to school because he's just coasting through life now, but he doesn't have the huge income anymore. So I don't know. I will tell you, my wealthy clients were not professionals. They weren't like doctors and lawyers. My wealthy clients were blue collar workers that saved. They had good spending habits. If they couldn't afford it, they didn't get it, and they saved. And some of them were my older clients because they went through rough times and depression. I don't think credit cards were as big of a deal back in the day, so people did without. It's hard for us to comprehend that because we're so impulsive with all the options we have. So yeah, we live a little higher than we should, and that's a bad thing.
Well, thank you for
But-
answering my question, but
Yeah.
I appreciate that.
Yeah, and I might teach the class, but it doesn't mean I'm doing everything right. So these are, you know what I mean? Every problem aside from bankruptcy, I've probably had. I'm constantly, like, every 5 years, I'll find myself refinancing or doing something because something happens. But long, short, if these are things on these little bubbles that you see, spending more than you earn, that's a big warning sign. When you write it all down, if it doesn't make sense, you got to start cutting things out. Skipping on, like if you skip one bill to pay another bill, it's called robbing Peter to pay Paul. You take the money you put aside for the electric bill because it's not due for another 10 days and the phone bill's due first, and then you'll worry about that one later. That's a sign you're in too much debt. Using a credit card to pay your bills is 100% that you're in too much debt. Little subtle things, arguing with your spouse. Remember in the beginning, I said debt is very stressful. And then again, of course, if you're getting calls and letters in the mail for non-payment and stuff, that's definitely a sign that you're too much debt. But don't file for bankruptcy. That's a last resort. Come in and see someone at the credit union, have a conversation, see if they can do anything to help you before. That's a last resort. So here's the more specific signs, and I like numbers, so I'll tell you in a minute the numbers. But living paycheck to paycheck means no sooner do you get your paycheck, you've spent it and you're waiting again for the next paycheck. Been there, done that. It still happens a lot. Debt to income ratio. So here's how they look at it. If you get the credit report and you add up all of the monthly payments you have, and you divide that against your gross income, if it's more than 36% of your gross income, chances are you're a little bit extended. If your credit card balances exceed 10% of your income, if you make 40,000 in this situation, they're saying not to have more than 4,000 credit card debt. That might be tough. If you make 90,000, you can carry more debt. Depending, again, it's all relevant, because if you bought a house that's too expensive, you may be in as bad a shape as the guy that makes 40,000 because he got a house that he can afford. Does you see what I'm saying? So there's no set rule, but these are little mathematical things you can do to kind of see where you're at. If you have no emergency fund, and we said the ideal to have put away is 3 to 6 months of all of your bills. And the only way you'll know all of your bills is if you write it down and have a written budget. that is rare until people get older because it's just too many things happen in your day-to-day life. But if you can get there, it's such peace of mind. If you don't have any money saved for retirement, if you're not saving, you have got to save every paycheck, even if you start with $5 a pay period and increase it a little bit as you're not missing it. You have nothing to draw from if you aren't putting anything away. So your credit report, what is it? This is what's made up of your credit report. There's information about you. Identifying information is your names, your previous names, your new names, if you got married, divorced, if if you're a male and you had a junior, maybe you added a senior to your name. There's the credit information. Everything that you have borrowed, whether you've paid it off or not, is listed on your credit report and your payment history, whether you paid on time. Public record information. What do you think that is? That's one that, people don't usually know what that is.
I do.
Oh, tell me.
So unfortunately, public record information is if somebody's taking you to court.
And
isn't
what
it?
do they do in court if you lose?
You end up paying them money. And
They put a lien against anything you own. So when in Delaware, if you buy a house, you need an attorney. The attorney does a title search and they make sure that there's no liens against you because you can't sell your house until you pay off the liens. So let's say I'm just not going to pay you because I don't feel like it. You took me to court and I lost and I owed you a couple $1,000s. They're going to slap a lien. And when I go to try to sell my house, I can't sell it or when I do sell it, that's the money they're going to take right off the top to pay back the person as a lien. So any liens or judgments, if you have child support or alimony, all that stuff goes on there. And then inquiries. Every time you apply for credit, it goes on your credit report. Every time you apply for credit, you lose 5 points. Every time you accept a new line, you lose another 10. So every new credit card or line of credit, you lose 15 points. It takes a year to get them back. Every time you pay a bill late, a utility bill, and they report it to the Bureau, you lose 60 points. When you bring it current, you get 45 back. It takes a year to get the rest. If you pay your mortgage late, you lose 90 to 120 points on your credit score. When you bring it current, you get about 3/4 of them back. It takes a year to get the rest. You can see how quickly your credit score can go from 700, 800 down to 500 or 600. Miss the mortgage once, have a couple utilities late, you're losing a few hundred points. So your credit report has all that information. And if you can get your credit report a few times a year for free, we'll talk about that in a minute. So what do you think an average credit score is? Average credit score is going to fall around 693. And 693, it means that you pretty much pay things on time. And that's a good place to be. You're going to get a decent interest rate if you borrow money. But as you get lower, if you see like from 620 to 679, you've had multiple late payments, you've damaged your history. You're going to start getting a couple extra percent tacked on. When you get over to 580 to 619, you're going to pay a lot of money, way higher interest rates to borrow. Usually from 0 to 579, there's a good chance no one's going to lend you any money. And if they do, they're typically the loan sharks who are going to take full advantage. Don't ever go to payday loans. Try to stay away from pawn shops and things. You never get the value for your item that's special for you. But the payday loans, they're can be up to 700% interest. They should be illegal. I don't know how they get away with it. And then
Sue,
yes.
if I can just interrupt, and how this applies to Habitat and how we do things, because we have at least one approved partner on here we're gonna have to run our credit again. And then somebody who's looking into homeownership. So Habitat has, I won't say lower standards, but we have different standards than the average lender. So your debt to income ratio that Sue talked about, you want it under 36%. That's a really good thing. We require it to be under 43%, which is about as high as it can go out here in the world of buying a house. And we require a credit score over 600. And and the fact that Sue was talking about liens against your home, we require, we allow a little bit of debt in collections when someone applies, but not much, because for exactly that reason, because we don't want to try to sell you a house that somebody's going to put a lien against the
Right.
second that you get the house. And so, while that's discouraging to some folks when I have to tell them that they can't proceed, it's to protect them. And people always ask me, the first thing they ask me is, what kind of credit score do you have to have? Basically, if everything else is in order, like you're
Mhm.
doing all the things you're supposed to be doing,
Mhm.
you'll have the credit score that you need to have.
It's true, and we can help you get there. Dover Federal does plans to build a repair credit free of charge, so we're not out to gouge anybody or make a lot of money. It's something super cool we just started with our credit cards only, but eventually we're going to add that to our other items. If you see a credit card offer and you think, gosh, I wish I could switch to that credit card, but I know I'm not going to get the best rate. Our lowest rate on our MasterCard is a fixed rate as low as 5.99. You may say, well, my credit's starting to get better, but I don't want to like run it and then bring it down if I'm not going to get the card or get the good rate. Dover Federal has a new thing in the application where you can put the app in and we'll tell you what your offer is going to be. And you won't get a hard pull unless you hit accept, which means you haven't dinged your credit like you normally would when you apply. So that's really cool. And that's something we just rolled out for just our credit cards only right now. So if you don't hit accept, you haven't taken the 5-point hit, which could be the difference between getting approved for a mortgage and not, you know.
And
During the
then-
mortgage process too, you do not apply for anything, do not spend, and you don't put anything on your credit card, or you could get, even if you got approved for the mortgage, the day they go to settle, if you've charged anything during that period of time and they pull credit the morning of the closing, they can cancel your loan. So do not charge anything during, or don't buy a car, you know, buy anything on credit until you get in your house and your keys in your hand.
I can attest to that. So my previous gig in another affiliate, we
Mhm.
had a lady go out and buy $6,000 worth of furniture the week of settlement and she put it all on credit
Yep,
for her new house before she closed on her house.
yep.
And then we had to delay her closing for 6 months, I think, at least 6 months before we could begin again, because she had to pay all that off and then get everything back to where it needed to be.
It
So-
changed her debt to income ratio. So that's so critical that you listen to that. But remember I told you that the amounts owed, that's your like debt to income ratio. That's 30% of your score, but the highest rate is 35, just simply paying on time. 10% is a healthy credit mix. A healthy mix are some secured loans like a mortgage or car, some unsecured. You want to mix. You don't want all unsecured credit that makes you look high risk. This is a big one, 15%. Lenders look at how long you've used credit. It's like your report card. They want to see some history, how your grades are over time or how your spending habits are over time and you're repaying. And then 10% is new credit. Are you constantly applying for new cards because you're going to get 10% off? You're going to get some special discount. In reality, you end up paying far more. So try to get like a Visa or a MasterCard and maybe 1 or 2 other cards. You can't have a card to every store. It just isn't worth what you're going to save. So that's the credit score. That's how they weigh it. And I'm not going to go any further because I really feel like the rest of this is just talking about what to do, you know, and a lot of it stems from the budget, but you need to have a plan. You need to get organized. And the reason I'm just going to skim through these things real quick. When you put together a written budget, which is page 6 of your handouts that are going to get emailed to you. And if it doesn't, if your income is less than your expense, you're gonna have to skim through your expense and see what things you can cut out. The first thing I always do is go to the automatic subscriptions and payments to gyms and magazines or whatever else and get rid of it all. And then see what I can live without. Sometimes it's going to take real sacrifice. You might actually have to give up something that you pay for weekly because you really need to scale it back unless you make more money or get a side thing going on. or you sell some things to bring some more income in, but the rest of this class really deals more with the budget. So when it says get organized, I share with people, after you get your budget together, when you get your bills in the mail or however you get them, put them in order of the dates that they're due and make sure that you don't have any surprises. And that's what the written budget does for you. Once you start, when you write all your debt down on the first paper that it's going to be sent to you. If you're not in a position to refinance because your debt's just simply too high right now, you write your orders and you write your debt down in smallest to largest. It's called a debt snowball. And then let's suppose you have a Kohl's charge card. Your minimum payment is $20 a month. And the next payment, let's say, is Macy's, and your minimum payment is $50 a month. And then you have a line of credit and your minimum payment is like $60 a month. You write them from the smallest payment to the largest. And the reason I say to do it that way is because it's more encouraging when you start to see some success. So if you can squeeze an extra $10 out of your pay, on the Kohl's, you're going to pay the minimum, which is $20 plus $10. So say we're going to pay $30 a month until it's paid off. But all the other debt, you're going to just pay the minimum. So you're only going to pay $50 on Macy's, you're going to pay $60 on the line. When you finally make the last $30 payment and pay Kohl's off, you're going to line through that, or you can rewrite your sheet or whatever you want to do. Instead of saying, yay, I have $30 extra a month. Now you're going to take the $30 you were paying on Kohl's and you're going to add it to the $50 you're paying Macy's. You're going to chunk away one debt at a time. As you eliminate one debt at a time and you're paying down your debt, your credit score is coming up. Somewhere in the middle of that process, you're going to bring your credit score to a good number. You're going to be able to refinance all of your double-digit debt into a nice single-digit interest rate and be able to chunk away at the debt even faster. Does that make sense? Does anyone have any questions? One of the things we teach at the credit union, we want to educate you, and we don't want to just leave you on your own. If you come in with your budget, or if you need assistance creating the budget, bring in your bank statements if you're not part of the credit union. And then if you have your monthly bills, if they're fairly consistent, or you write that information down, we can help you to put together a generic budget and then look at your credit score and kind of give you some advice, some direction. When somebody takes a look at it and kind of gives you a game plan, you just got to follow the plan. My son went into the credit union with a 400 credit score. I said, I didn't even know it went that low. He did the credit score plan that they did for him. In less than 4 months, his score was over 700. He took the car loan that he had, was paying 10% interest. He didn't have the best credit score. He got to 700. So we got a 5% interest rate, which cut the interest in half. And he got his payment down from $550 to like $380 to $345 a month, I think, which gave him some breathing room because the type of work he does is in different seasons, it's more profitable than others. So long, short, when he has a less pay, he can make the payment now. Does anybody have any questions? Because we can help you individually because everybody's situation is different. So does anyone have any questions? I can
Nana,
put,
are you there?
I put my phone number I can put it in the chat. And if anybody feels like they want to talk to somebody, I can have get an appointment for you with someone. So my name is Susan Yoakum, and my phone number is 302-505-0631. This seminar has a lot of information. And if you want to talk about just your specific situation, sometimes it resonates better with you when it's about you and not just general. So
let me hold on a second. I'm gonna Nana, are you still with us? I'll make sure that everybody's still here. Nana, Dwight.
Yeah.
You're still here. Yay. Dwight, did Dwight come back to us? Dwight stepped away. I don't know that we got him back, but Nana's still here. Okay.
It's hard to listen to stuff at night. I appreciate
Yeah.
your attention and I'm sorry for the little choppy start, but
No, it's okay.
yeah, so if anybody like has any questions, like if you can call, I can set you up with somebody in one of the branch offices where it would be private and you can talk about your own situation. But it can help you get organized, but don't pay for credit counseling. Because if you do, it's just going to be more money out of your pocket and it usually doesn't get you where you need to be. Ours is free. So whatever you can get for free is what you should do.
Well, it's wonderful to know, Sue, and I give people the same advice. I never heard the debt snowball. But I give
It's-
people the same advice when they're facing delinquent debt,
Mhm.
like take the smallest one. Get rid of
Yes.
the smallest one.
Because you
Because
feel
then
a
you'll
sense of
feel that.
accomplishment, you know?
Yeah, and
Now the-
while you're doing it, your credit score will rise because you're like, if you can pay the smallest one that's on your credit report, like get rid of it. And I've seen debt sold to collection agencies
Yeah,
for $4, for $6.
yeah.
That's taking down your score, and like just call them up and pay them at that
Well,
point.
the credit union, that's what they do. They look and see which things you should pay attention to first to get the biggest bang for your buck. How many points you're going to get if you do this or that. And that's a credit agency that charges you money, guarantees they're going to increase your score, but they dispute everything on your credit report. And when in fact it's stuff that you did, whether life, you know, you had hit some bumps in the road along the way. Once all your disputes are declined, your credit score is going to go right back down. So it goes up temporarily. So now you're out the money and you're still going to get the bad score back as soon as all your disputes are declined. So for a short period of time, it goes up. So that's another unethical practice. So I just, we don't do that. You know, sometimes we provide education and sometimes people decide to come back to us. We do offer free accounts. We are not for profit. We help people, you know, wherever they're at. And I like that. You know, when I was in banking, I felt more of a push to sell. And I never liked that. I always liked working with people where they're at right now, you know, so, and that always worked for me. And then fortunately I got to go to a credit union and that's what we do.
So you don't need to be a Dover Federal Credit Union customer to come and take advantage of free credit counseling, correct?
No, the only thing is they will be pooling credit and you do lose 5 points when they have to do a hard pull to pull the credit.
Okay,
But if they were looking for an account, we have free checking unless they're in check systems. If you're in check systems, we have second chance checking, which very few financial institutions will open you a checking account. This one does have a fee. I believe it's $6.99 a month. And I think you have to manage it for a year without overdrafting and then they'll convert it to a free account.
okay.
So if you can't get a checking account, it's really hard to keep track of receipts because when they fade, that's not proof if no one can read the receipt. So having a checking account gives you electronic record.
Mhm.
The government restricts you from using a savings. You can only do 3 withdrawals a month or 6 transfers in a savings, which again seems unfair. It's your money, but it's not a bank or credit union rule. It's a government rule. It's a regulation. I think it's called Reg D and it's a violation. Savings accounts can't be operated like checking.
Mhm.
But that's for another day. But if anyone has any questions, yeah, our only goal is to help you be successful because we know that we can help you. So good luck. Congratulations if you're on the path to home ownership. And
Heather, my coworker, is buying a home, not from Habitat, but she's buying a home. So she's been listening intently.
Yes.
Good. Some of it's just life experience, but you know, everything is trial and error. But if we can help you avoid a few of the errors, great, because you know, nobody really sat down and talked to us growing up. Like, I'm in my late 50s. I think that's why Dover Federal really wants to stress education in the community, because even in school, not everybody gets this type of education. And we're in the schools a little bit. We're getting back in soon because of COVID. We were out for a while. We teach classes over on the base at the military. The more you can help people avoid some of these mistakes that we've all made, the better life they're going to have, because financial mistakes affect every area of your life. Yeah, so
All right, is this our last slide?
we're not going on because the next piece of what we need to do together is more about budgeting. That's all, the best way to get organized is to create a spending plan, know where you're at, not guess. And we teach you how to set a goal, and it's all that good stuff. So
Nana, are you still here?
I might have put her out. So we're running a little bit late, but that's simply, we started a little bit late, and
That's fine.
yeah, you don't want me to go on because this is a good stopping point.
Well, thank you so much for presenting to us. I know we
My
had a-
pleasure. Thank you for having me, and thank you for doing it via Zoom.
We'll-
Now I'm
we'll-
home, so I don't have to worry about driving.
Well, Heather and I are going to go home now, but no, I learned things. Thank you, because every time I do one of these, I learn things like the point system. I had no idea
Yeah.
how they figured out the points.
Yeah, I learned stuff when I do it. I just can't believe that no one ever taught this before. So when I came to the credit union, everybody who goes to work for the credit union has to train on the credit report. And I thought, that's so important. So the 3 times a year you can get one from each of the bureaus. So Equifax, TransUnion, and Experian.
For the free ones.
And if
yeah.
you're turned down for a loan, you can get another one from the bureau that turns you down. So long, short, get your free report, make sure there's nothing on there that isn't true, because you don't want to wait to find out your credit's been damaged when you need it, because then it takes a while to clean it up.
Yes. Heather's been all over it. She has been on her credit sesame or whatever.
Yeah.
And yeah.
Well, Heather, you're doing the right
thing.
thing. Knowledge is power. Staying
Yeah.
on top of it.
Yeah, no,
Life goes along, and all of a sudden you need your credit. Like the old folks, they're not buying anything. And then all of a sudden they need a car, and they come in, and someone's been using their credit, for fraudulent things. And it takes a while to clean it up. So they might lose the car that they wanted. So you just have to keep an eye on your stuff. There's a lot of fraud, a lot of identity theft. And some of it is simply just stupid stuff that we do, but hope you ladies and gentlemen have a great night.
Thank you.
I put my number up there. You're welcome to call me. And anybody at the credit union, where they all get trained on the credits.
I will make sure I send you some folks.
I appreciate it. And if you when you're ready for me to come back in person, we'll have dinner and we'll have fun.
Yay. Pizza
Thank
and
you.
budgets.
All right.
It'll make everything better.
Yes, eating makes everything better.
Yeah. Oh, thank you, ma'am.
Yeah.
Good
Thank
night,
you.
Nana.
Good night, everyone. Thank you.
Bye-bye.
Bye-bye.